Hello and welcome to the Boom, Doom and Zoom show. Switzer. I'm joined by my colleague Paul Rickard. Hi, Paul.
Good afternoon, Peter. Good afternoon, everyone.
So it's an interesting time. Just when we looked like we were going to be the great beneficiaries of what I called the Josh Frydenberg rally, along comes second wave infections in the USA and Europe and a lack of a stimulus program. I call it the stimulus stalemate. And the market is sold off ahead of course, the US election on November 3. Paul, are you worried or is this a buying opportunity?
Look, I'm not really worried, Peter. I suppose I'm a little surprised. I guess I'm a little surprised that, the second wave was obviously coming.
Yeah.
And that sort of, you sort of think, what are they didn't take any notice of it last week. I mean, you could argue Europe's a fraction worse than anticipated. I think
they've closed down in some places.
They have, but the numbers are looking pretty bad last week in a lot of places. So okay, so I guess you could be a little bit surprised, but the reaction in the US, I think this is all just part of the election thing, Peter. It's going to be nervous. I don't think it's quite a buying opportunity, but it's not far off. I think between now and the next week and a bit, we're going to have a lot of nerves.
Yeah.
There's going to be some opportunities.
And it's going to be very interesting to see what happens after the election, Paul. If Biden wins, whether Wall Street will go down another leg. I think if that's the case, that's when I'll be looking for an opportunity to buy in.
Yeah, well, I wrote a brilliant piece today, Peter, that you're probably aware of, about saying what I thought would happen, which, Trump wins, there's a relief rally. I think that's unlikely. Yeah. Biden wins with a clean sweep. That's where he controls the Senate.
Yeah.
I think that's still going to be a negative, because I agree with your comment about that actually means a bigger stimulus package will happen.
Yeah.
But I still think the market, they don't like,
the Democrats having too much control.
Democrats having too much power. So I think longer term it's okay, but I think the short term it's a negative. And then Biden wins and the Republicans retain control of the Senate. I think they'll then just wait. I think the next step, then they'll start to say, okay, now what does that mean for the stimulus package? Let's see it.
Yeah, and it also means that if Biden has too silly a regulations program, the Senate can say no.
Yeah.
But they might pull back on his stimulus. So we might, A, get a stimulus, but B, it just won't be as excessive. That might worry Wall Street.
The other thing that's probably unnerving Wall Street too is just as it tightens a little bit is the prospect of no outcome and going through that horrible process of courts and Congress and disputes.
Do you
and
think Donald Trump would do something
No,
like
I
that?
don't. Donald wouldn't do that, would he? So, that's got to be bad for markets, right?
Yeah.
No one's going to like that. Yeah. Everyone wants a clean outcome, right?
Yeah.
Whether it's a split house, a clean sweep or not, everyone wants an outcome, not no outcome. And maybe that's also what we're seeing too.
Final question. We're doing really well. We've heard that in the September quarter, the Reserve Bank thinks we're out of recession. I got to say, Paul, I was a little bit surprised about that. I thought we'd get a small negative, but and I was on the Credlin show last night, and I was going to earmark to have a debate with Terry McCrann, and we ran out of time. I actually, when Credlin asked me about whether we're out of recession, I said, well, it looks like we are out of technical recession. And Terry said, no. So he's up for an argument. I'm going to try and get an interview with him so we have a bit of an argument on this. But I've since surveyed 7 really well-known economists, the Craig Jameses, Shane Oliver, Paul Bloxham, Deanna Masuna from AMP Capital. You know what? Every one of them says September was positive, despite the Victorian thing. It's quite staggering me. So the recession is only going to be a 6-month recession, and December is expected to be stronger than September. So we're out of recession, definitely this quarter. So it's just quite staggering. So my question to you is, can we, as a stock market, go up at a faster rate? Can we rebound quicker than the US?
Well, I think we can. I think that there was a great reason why we were rallied the last couple of weeks. There was a Frydenberg rally. The budget was really good for the market.
Stimulus was there.
And the stimulus is still there. So let's not lose sight of that. Now we're we're just taking a lead from the US. Interesting, as you said, we're Dow's off 6.5%. We're off about 2 or 3%. So we're holding up better.
Yeah.
We're doing better today. I suspect we'll probably have a bit more selling before the close. Just one of those days, but we're still going to do better than the US. Yeah. And I think that there's still more upside. We can do better. So
there's like a market premium for being good at beating the coronavirus as well, isn't it?
Could I just ask you one question? Because
Yeah.
I hope this was public, but you told me of what I thought was a really fascinating story from your podcast during the week with Steve Gusick,
Yeah.
the managing director of
Yeah.
Webjet.
Yeah.
Just tell them about the number. Can you say how?
Because it's out there now. So if people want to listen to the podcast, so I interviewed John Gusick,
John Gusick,
the CEO, MD, I always say CEO, the MD of Webjet. And, I really wanted to get an idea of how long he thought it would take before, business would start improving enough to justify even the rise in the share price that we've seen. I must admit, personally, I bought it at very low levels, expecting it to take me a year to do well out of the stock. It's done a lot better than I expected. He said a couple of things. I'll save Paul's very interesting point to the last moment. But he actually said the coronavirus has helped the company just basically rip out a whole lot of costs. Mm-hmm. So he reckons he's going to be, his company will be profitable when the borders are opened up. Not including
the domestic borders. Right?
Domestic borders. Yep. And I was surprised that the domestic trade is so important to the bottom line. He said, but it's become more important because they've been able to rip out the costs of his business much better than before. But he also said, and he was surprised about this, that before the coronavirus, 10,000 shareholders were retail customers. The rest of them were big institutions. He said now 65,000 shareholders are retail investors. He was staggered. That's a big jump, Paul, isn't it, from 10 to 65,000?
So I take two things out of that, Peter. One is it just shows you how many are already on the reopening trade. So there's a bit of caution there. But two, I guess it's both positive and negative for the market. It does just show you how much the market has changed because the impact of zero cash rates, right? Yeah. And how people got nowhere else to invest. That's a very bullish factor for the market.
Correct.
But you can also argue it says, well, maybe a lot of people punting out there, right?
Oh yeah.
And you can say that maybe is it, and that means with sell-offs when they're going to come, are going to be pretty punishing, right?
Yeah.
So
unless the professional is the person who often will go for the exits faster than the amateur, the mums and dad investors. They might just say, well, look, I'm in here it's better than term deposits. I think a company like Webjet might have a few struggles if the infection rates go up. But at the end of the day, we will start traveling again. And by the way, one other thing he said in the interview was that he was poised to raise his earnings guideline just before the coronavirus.
So this isn't now, folks. This is back in February, right?
Back in February.
But just before the virus hit. Yep.
Okay, so if you want to ask any questions, you can text it, obviously. Just go to the respective Q&A icon, or else hit the raise your hand icon and we'll get you to ask a question. One of our regular questioners is Craig with a capital C. Hi, Craig.
G'day, lads. Just got a question regarding PPE. Your thoughts?
PPE, Paul?
You've got me. I'm just going to have to look.
He spends a week. Craig spends
PPE.
I know. I just got to look at that.
I'm going to have to. We have to take that one on notice. People infrastructure. You've got a chart on that one. I don't. Is that it? Must be. Craig, was that called something else before? We get Craig back? I'm going to have to take that one on work.
I think it's on screen now, Paul. It's called People Infrastructure.
Yeah, it must have had a name change, did it? Yeah. Craig, are you back there?
I think it's similar in the nature of ELO in the hiring of people type of thing, and it just seems to have been a fairly steady grow, as you can see by that graph.
No, look, I think we'll have to. I'm going to have to pass on that, and I don't think you got any analysts there, Peter. But
no, I'm having trouble even.
I'm just having trouble with thinking of the company unless it was called something beforehand, which I think it must have been. So let's come back to you on that, Craig.
Yeah, well, it certainly was something we'll throw at Julia or one of our other experts on Monday night, Craig. You're a great man for putting us on the spot in that respect. PPE, I got the analyst up.
Yep.
I'm sure it's not going to be here. It looks too small. Right.
Yeah.
I like him.
I'm just going back on the announcements to find out what it was called before. But
Well, actually, it is. It's got, the analysts think 0.2% downside. Looking at the chart, can we put the chart back, John? Yeah, it's obviously gone for a nice rise, Paul. And looking at the fact it's gone down, it is, starting to rebuild. It's not a company I would dump. And certainly I think someone like Julian might have a view on the matter, mate. So we will actually put it to our experts on Monday night. Now, I'm doing this without glasses. I'm going to struggle here. That's okay, John. I can get through it. I'll just put the thing on. I've got long arms. I can get away with it. This one comes from Tony. And Tony says, hi, Peter and Paul. What do you think of Unibale Westfield and Woodside Petroleum as long-term holds? They've been beaten up.
Yeah,
since
I
COVID.
go with the Unibale. Look, I'm sorry I didn't dump Unibale a lot earlier. I always felt that when the Lowies got out, that was the time. And
Yeah, you're
initially I got sucked in. I didn't act, and I got sucked in thinking that the Unibale Rodamco people, which of course is a huge operation in Europe, really knew what they were doing. It's been a very disappointing, effectively huge property trust, which also has problems for Australian shareholders because we don't know where we'll get all the withholding taxes, lots of complications because of the Paris tax. And I'm still a shareholder. So,
Paul, explain to people watching, what's the difference between this mob and Centre Group? Because Centre has some of Westfield stuff as well.
Centre Group owns all the Australasian Westfield shopping centres.
Yeah, okay.
What was sold into Unibale Rodamco was all the European and Americans, the old.
Anderson Club, like in the World Trade Centre.
Yeah, World Trade Centre, the big one in the UK at the Olympics, where the Olympic Stadium is. What are they?
So Paul, in a sense, because it's European, do you think the coronavirus has really hit them a lot?
Well,
and the lack of tourism as well?
It has hit them harder, right?
Yeah.
So, and I think to be honest, they just don't have the Lowies clout, right?
Yeah.
I think it was
Understanding retail the way that is.
Follow the money. I mean, they hang on to a lot of their shares, but this was the Lowies exit, and it's been a disappointment ever since. So I'm sorry, at about $10 was the time to get out, and then I missed the whole thing. There's currently a capital raising proposal. I'm not sure I've got a position on that yet. It's just not on my agenda to buy. I'm not sure why. And you want to be long European real estate.
Yeah.
That's the first statement.
Yeah, certainly, Tony. I will ask our experts. Only from the point of view is that if you want to factor in that, say, in 2 years' time, the world is back to madly travelling to London and Paris and places like that, a stock like this could easily be, was it $2.94? It could easily be a $4 stock. And if you make $1.10 on $2.90, that's not a bad return. But that would be the kind of analysis you'd have to factor in over the.
We'll get the analyst. What was the other stock? We got a lot of questions here we should take.
Yeah.
Woodside.
Yeah.
Look, the oil price, the LNG price. I mean, I think Woodside. I think it's a long-term hold, right? I think Woodside will come good again at some stage. So hang on to your Woodside. At the moment, until you see sustainable improvement in the LNG spot price, we're probably not going to get much from Woodside. Obviously, in the last few days, the oil price has come under pressure because of the what's happening in Europe has fallen. So, but I think Woodside is probably getting pretty close to buy zone.
Yeah, I think so too. I got in a little bit lower a few months ago. It got into the 20s, and I thought I was a bit of a genius. The thing is this: the problem for the world economy because of infection rates is going to affect oil in the short term at least, because if you don't recover as strongly, therefore the demand for oil, the demand for airline fuel, all those things go down. And that's why there's going to be some time before you get the bounce. But the bounce will happen. And by the way, Tony, getting back to you on Unibale, the analysts think there's about 23% upside for that stock, 32% upside. And it's basically working on the idea what I said. They've got a target of $3.88. So it's kind of quite believable they might go from $1.98 to something like $4 over a year or two. These guys have a much shorter profile than 1 or 2 years, don't they, Paul?
They do. I mean, I'll just read you what Morgan Stanley got decided. It's got an underweight call. So Peter's right. They've actually got a 39% upside, but this is what Morgan Stanley put out just a week ago. Unibale will be publishing its third quarter results on November 1, so that's next week. There are 4 things Morgan Stanley is keenly awaiting updates on. These are portfolio valuation declines, rent declines and renegotiations, disposal progress, and more detail on the credit lines. The broker expects capital values will fall by around 35% on average peak to trough, and suggests valuers be market observers rather than market participants. Underweight ratings maintained with a target price. It's 10 euros of euros 35. You'd have to convert that back to Aussie. It's 1 for 20, and it's probably about $2.50, $2.60.
Yeah. So there is upside, but it might take time. It's going to rest on, I think, tourism recovering, because that big chunks of the retail in those places come from tourists as well.
Yep.
Okay, let's go to our next question. This one's from Craig with a little c. Go for it, Craig. Craig Boylan.
Yeah, g'day guys. I was just asking you last week, Pete, about Zip, and you sort of said to me we would buy it around the $6.50 mark. Luckily, I didn't do that. It's set currently at $5.89. Do you see this
Yeah.
the bottom, or what's your?
Well, it's not too far off 6, mate, but you're hard, man. Yeah, we're losing you, Craig.
Sorry, can you hear me now?
Yeah.
Oh, sorry, mate. I'm just being a bit rough on you. That was all. Sorry.
Yeah.
Thanks.
Do I think this is a good entry price for Zip? Well, look, I as you know, I got in at a much lower price than this, and so I'm not buying at the moment, I must admit. If I saw it drop down into the low 5s, I think I would. I think it's a good company. I like the fact it's paired up with Visa. That's good. Remember, it was knocked around by the fact that Westpac sold its shares to jump into bed with Afterpay. But I still think it's still a good company. And it's, you know, if you look at the charts on screen there now, there's a number of pullbacks, Craig, and see the way it's bounced out of it. I think once we get back to a more normal 2021 when it comes to retail and economic activity, I think these guys will keep rising like that trend line is showing, Paul.
Yeah, I mean, look, we're getting here the US effect, and remember the whole not Afterpay market, the whole buy now, pay later market is horribly overvalued, right? Yeah. But we're the leader in it, and Afterpay's done really well. But as tech companies, they're really expensive, right? Yeah. And so when you get a bit of a pullback in Wall Street, you're going to get pulled back on these stocks, right? In a relative basis, Afterpay's done a lot better the last month or so than Zip. I just think the sector's too expensive, right? But I've been wrong to date, so I'm prepared to sort of wait and be patient. Yeah. I mean, there's some huge technology reports tonight in the US, which are probably going to set the tone there for that market. Yeah. I just think today's probably not the day I'd be piling into it. I don't think it's had enough of a pullback to say jump into it, right?
And as I said to you, Craig, if it got around the 4 again, I might buy more. I would be dollar cost averaging up rather than down, but still, I do think this is a good company. And the way that they've added new parts to their business, a bit like Afterpay, makes me think that these guys are heading in the right direction. I think they've got Joe Hockey as their overseas lobbyist as well, by the way. That's another little point. All right, next question. David Kedwell. Take it away, David. Okay. Having difficulty with the microphone, I'd say. Let's go to David Robertson. Can you provide some commentary on the Contango income generator? Even if you are compromised, I would appreciate your views on the proposed WAM takeover. Paul?
We're not compromised. So the recommendation that's been, there's a bit of statement out. The board for Contango has responded today with their suggestion, and they're saying two things: that if you really want to stay invested in the new WCM global growth long short strategy, then you should reject the WAM offer and just stay invested. Okay, and that way you'll get a chance to take part in the new strategy. There'll also be a 1-for-1 entitlement issue down the track at a 90%, at a 10% discount to the NTA. There'll also be a bonus, an option as well. Yeah. Okay, so effectively you'll enter the strategy at a 95% because you've already got one share. had another share, effectively you're getting into the strategy at a 5% discount. So that's what they're saying. If you don't want to invest in the WCM long short strategy, then their recommendation is accept the WAM offer. And I think
And you end up with WAM shares.
you end up with WAM shares. The risk with that is that WAM shares are massively overvalued to what they're worth. You won't get them for a month after the offer closes.
And could a lot of people want to sell?
Well, there might be a lot of sellers. I mean, you look, if I just, the WAM NTA is about $1.90. So that's the downside with that strategy. You'll take a month after the offer closes before you get the WAM shares. So that's exactly what the board of CIE is recommending, and I think that's the right recommendation.
And I think if you like the idea of switching from an income fund to a long-short fund managed by WCM, which is one of the best fund managers in the world, basically you'd stick with it. I'm going to stick with it, I've got to say. I'm going to stick with it and take up the rights issue as well, because I think I like the idea of being in that kind of investment. And I also like the idea that Jeff Wilson, who basically wanted to take on that fund, is now basically saying he likes WCM and he's going to market it to his own group, that this new version of CIE, which will have a different name, is something that he thinks will be a good investment opportunity. So it looks like, there was a bit of a war. Looks like they've come to a bit of an agreement, and they're given options for people who want to get out and take the money and run, or other people who want to stay in there and go along for the ride. I think there's two options there. So just you just work out which one suits you. Okay. Next one. This one's from Carol. Paul, I appreciate you responded to a question, Ray WAM's bid to buy CIE last week, and spoke of WAM being overvalued. I understand that when CIE was seeking an alternative manager, WAM advised that they were unable to engage with CIE due to capacity issues. So I'm trying to assess why WAM is now interested in CIE. Does this mean that WAM highly values WCM as well? I basically answered that question.
Yeah, I think you have. Yeah. I mean, I think the answer is yes. And look, I think the cautionary tale here, and there are a lot of WAM shareholders out there. Now, WAM's done as investment performance is really good.
Yeah.
But the share price, we're not talking about the investment performance, we're talking about the share price, right?
Yeah.
It ain't worth $2.28, right? If you're a WAM shareholder, it doesn't matter whether I believe in CIE or not, I would still tell you to sell your WAM shares, right? Because I reckon if you asked Jeff that question, he'd probably say the same.
Well, he actually did say it to me at our conference. And I said to him, if your daughter said to your dad, as to Jeff, where would you invest in your fund? I said WAM Capital. He said, no, because it's trading at a premium. He said, I've always liked to get $1 for 80 cents. So he thinks he's got other funds that have more potential. But as Paul said, if the market values WAM because it's done well in the past, it kind of effectively overvalue it. I think it's a really complicated thing. I think it gets down to one bottom line is, if you went in this whole thing to try and make money, well, then you probably should try and make money. But if you like the idea of the WCM long short fund, which I like, Paul likes, and even Jeff likes, well, then it's worthwhile thinking about going along for the ride. But ultimately, it's going to be your choice.
And you should read the bidder statement, not the target statement. So CIE's put a full statement out there today. You can download it on the announcements page. It's about 40 pages. And that gives you all the arguments for and against.
Yeah, and I might write some sort of simple Switzer version of the whole thing as well. All right, Shirley's got a question for us here, Paul. Is it QCB it's a synthetic ETF, QCB, and it's on the Australian Stock Exchange.
Yeah. Look, I think that trades a basket. I'll have to check what the basket is. What was the question?
Well, the question is, hi, gents. I guess basically, so what do you think of this one?
Like all ETFs, the first question is, what is the index? And I just have to, we'll look up. I'll go to BetaShares site while we're talking. I don't really, I think you can get so easy, get exposure in Australian commodities. You don't need this. Right? There are so many ways you can get straight. I mean, personally,
it's done pretty well. That's what you're looking at.
But that's probably a fair bit of that's currency. So that's important. So hedge, but it's so we have so many opportunities to invest in currencies, commodities. The last thing I need to do is have another commodity fund. All right. So that's why it's never sort of come against me. What is the one? It's
It's
QCB.
QCB, Paul.
Okay, so it tracks a basket of, if I just bring it up. What's a basket of? The index is the, so it's a S&P light energy index. Okay, so it's really tracking sort of oil and crude and things, right? So look, yeah, if you want to have an investment in that, great. But there's lots of ways you can get exposure to that market through your Santos's or your Woodsides or something else. So,
okay, here's a question for you, Paul. Strategic elements, and
sorry, I just one correction. It's a mixed basket. It's about 35% agriculture, 20% industry, energy, 30% industrial. It's all sorts of things, right? I just pass.
Yeah. Okay. Now, here's one that the analysts don't cover. It comes from an anonymous attendee. SOR, it's strategic elements. I don't know it. It's going to be one we'll throw at our experts on Monday night. Paul, you got no view on. It's a nice name, isn't it? Strategic
It's
elements.
a great name.
Let's go this one. This one is a really relevant question. Dave wants to know what we think about baby bunting and polynovo. I'll look up baby bunting.
I'm not sure why baby bunting's just come off there so quickly.
Well, I'll tell you why.
Yeah.
Because it did very well.
Just look at that. Yeah.
It did very well with the lockdown trade.
Right. Okay.
But since the reopening trade has become popular, it's fallen with a lot of those.
It's actually above its February levels,
Yeah.
right? Which is there aren't too many stocks in that category.
Yep. And by the way, the analysts think that it's got 19.9% upside. And I'm not surprised. I think this is a good company. They basically saw off a lot of their competitors. And a lot of people thought that Amazon was going to knock them out and all that sort of stuff, a couple of years back. That's when they went off the boil. Then they proved themselves. And I think young people are actually out there having kids now. I think we're having a bit of a baby boom, which of course helps baby bunting. And also the younger generation, they seem to spend you've got some grandchildren.
Yep.
Isn't it unbelievable the way our kids spend money on these babies of ours?
The analysts are pretty positive on it.
Yeah.
I mean, 4 out of 4 have got buys on it, and they're pretty positive.
It's a good business, and let's face it. I know as a grandparent, every time a grandkid comes to town, we're going to go to Baby Buntings and buy a whole lot of stuff. So it's right in the right spot. Okay, next one, Polynovo.
I'm going to have to pass on Polynovo.
I'm looking it up. We have talked about it before in the past.
All right, it's PNV.
-7%. So the analysts aren't terribly against it, but you probably think it's probably a little bit overpriced. That's Nanosonics, mate. We have Polynovo.
PPNV. Nanosonics.
Can we go look at Polynovos for a second, John? Sorry. Yeah, well, you can see why they think it's overpriced. It's had a nice run up, pretty steep since September. Let's go to the next one, John. And the question is from another anonymous attendee, Nanosonics, NAN.
A company I find really hard to get a feel handle on. These are the tough ones today, Peter.
Yeah, but it does give us scope for pestering our experts. Nanosonics, according to the analysts, 8.4% upside. And just about every time I get asked that question, it usually is in the positive. Let's have a look at the chart. The chart's not promising. For them to say that, they must believe that a base is starting to build, Paul, around here. I'm not convinced. It still looks downhillish to me.
I've been burnt on Nanosonics before, which is why I'm wary of it.
Okay. But once again, we'll throw that at our experts. I always love doing the techies. We've got June Bailey in on Monday as well, and she's usually good on these sorts of techie type stocks. Question from Ian. Sorry, guys, I'm straining. I left my glasses behind, but thank God.
Regis Resources,
Yeah, Regis Resources.
Look, again, a good gold miner. I'm not. What's the question though? And sort of.
Well, do you like it or not?
Well, I don't know if I probably prefer some of the others in the gold sector, but look, the analysts won't really help you because it'll be based on the gold price. So it's one way to play the gold sector. Put it that way.
27.1% upside. Gee, it must have
Yeah.
been doing a lot wrong, as we can see. In recent months, it's gone off the boil badly,
I
hasn't
mean,
it?
I have preferred Newcrest, but Newcrest didn't come out with a fantastic production report today, or the other day. So,
You know, what also quite surprised me, Paul, is that the price of gold went down today, with the world worried about the global.
yeah,
outlook.
but it's as much as about a dollar play. The US dollar goes up, gold goes down.
Yeah.
So gold is, if anything, is more a function of of the US dollar.
But why would the US dollar go up when the economy looks crappier than ever?
Well,
which means they have to spend more money eventually, which takes the dollar down.
Well, it's flight to safety. I mean,
Yeah,
people are,
that's right.
I mean, it's sort of flight to safety in the US dollar, which then becomes a flight to a reversion for gold. So it's sort of, there's this perverse thing occurring here at the moment. If the US dollar weakens,
Yeah.
gold goes up and vice versa.
And this is the reason why I'm not a great fan of gold, because it's really hard to understand. Ladies and gentlemen, we are out of time. I'm really sorry that we've run out of time, but we'll try and answer some of these questions on Monday's Switzer Investing Show. We've also got Tom Waterhouse there as well. I'm going to give his Melbourne Cup tips from him and his father, Robbie. So don't make sure you don't miss that show. We're not doing this next Thursday because, of course, it's the webinar on Friday, the monthly webinar. So we'll see you instead on Friday of next week. Thanks for joining us. And if you have a bet in the cup, do well.